Welcome, everyone. My name is Adam West. I'm with Warren Averett, and
I'm LeGrand, also with Warren Averett.
today we're here to talk about the One Big Beautiful Bill and its impact on private equity.
That's right. Lots of changes, lots of taxpayer favorable changes to the tax law with this bill, and so we're happy to be able to speak to some of these today.
Yeah, Dave, I think the first one we want to go over is, let's talk a little bit about 1202 and what that is and some of the favorable changes there.
Yeah, so Section 1202, qualified small business stock, very nice provision in the tax law. Taxpayer favorable in the sense that you can exclude up to a certain amount of capital gain if you meet the requirements with a C corporation that you're selling the stock of. And they've actually kind of loosened the requirements with this new law in three main areas. The first is under the old law, you had to hold your stock for 5 years, and under the new law, you can hold it for 3 years and still get a 50% exclusion, 4 years and get a 75% exclusion, or if you hold for the 5 years, there's still 100% exclusion available. The second change that they've made is the exclusion previously was capped at $10 million per shareholder per corporation. They've raised that to $15 million or 10 times your basis in your stocks, the greater of those two amounts. So going from 10 to 15, we think is going to enable a lot of taxpayers to exclude more gain and save a lot of tax. And so in a transaction context, in a private equity context, where we see these portfolio companies get levered up and then they sell for a lot of money 3, 5, 7 years down the road, this has saved taxpayers tens of millions of dollars of tax, this provision. So we're excited about these changes, and we think that they're going to save people a lot of money.
Yeah, these changes, I think with these changes, Congress and the administration are sending a very clear message. They are encouraging investment in U.S. corporations.
U.S. domestic C corporations, that's right. I think this is a really powerful incentive. The other thing that they've changed to make it easier is under the old law, the assets of your corporation had to have a value or a tax basis of $50 million of less. They've increased that to $75 million. So larger corporations are now going to qualify. And we think that's going to enable people to qualify for this 1202 exclusion as well.
Exactly. They've really loosened the requirements to be able to issue 1202 stock. And I think what you're going to find is a lot more corporations being able to issue it. And this makes choice of entity really interesting.
It really
now.
does.
Prior to 2018, under the old law, when the corporate rate was higher, it didn't make a lot of sense most of the time to be a C corporation. But now you have the corporate rate at 21%, you have 1202, and those requirements being loosened a little bit. So choice of entity is still very much, and I think now more so than ever.
That's right.
Really important.
Yeah, I'm seeing a lot of private equity firms call us and ask to help them structure a 1202 position. Oftentimes, it's either an LLC where they make an election to change to a corporation, or it's an LLC that owns a corporation, are some of the structures that we usually see. But we're being asked about this a lot and able to structure this pretty frequently. And so we think this is a great incentive and some really nice changes for taxpayers in the tax law.
Absolutely. So another favorable change out there were the changes to the interest expense limitation, Section 163J. So just a recap, starting in 2018, taxpayers were limited. They were only able to deduct 30% of their taxable EBITDA in interest. So you basically compute what your taxable EBITDA is, and you could deduct 30% of that amount in interest expense. Well, starting in 22, one of the revenue raisers as a part of the TCJA, the Trump Tax Cuts and Jobs Act, one of the revenue raisers was starting in 22, that became 30% of EBIT. So for 22, 23, and 24, taxpayers have been calculating that interest expense limitation based off of EBIT. Well, a favorable change there, you're now able, starting for tax years, starting after December 31st of 24, you are now able to add back depreciation and amortization in calculating that 30% limitation. So much welcome change there that will allow taxpayers to deduct a lot more interest expense.
Yeah, that's right. We're seeing a lot higher tax distributions as a result of this business interest limitation. And in a private equity context, the structure we often see with the acquisition provides for tax amortizable goodwill, which can be a really, really large number. It can be hundreds of millions of dollars of goodwill that's throwing off 10, 15, $20 million of deduction every year. So if you can add that back to your base, that will facilitate a larger business interest deduction. We think that this can be very, very material and can kind of help with this timing problem a lot of private equity firms and their portfolio companies are having with their tax distribution. So we think this is a very welcome change.
Absolutely, and we've already seen this start to impact third quarter tax distribution. So
Yep. Way
the
down.
law was passed July 4th, and starting in the third quarter, a lot of those third quarter tax distributions had less taxable income because there was more interest expense that was deductible under the new law. So favorable change, and we're already seeing a lot of private equity groups and portfolio companies are already seeing the benefit of this provision.
That's right. That's right. Another area of the tax law that changed that we think will impact private equity is with respect to research and development expenses under Code Section 174. And historically, these were deductible up until 22 when some of these revenue raisers from the Tax Cuts and Jobs Act kind of came into effect. And starting in 2022, you were required to capitalize your domestic research and development expenses over 5 years and your offshore research and development expenses over 15 years, which delayed that deduction and caused some timing issues for some portfolio companies and some taxpayers. So they're paying in more tax from a timing perspective. The new law starting in 2025 will enable people to deduct domestic research and development expenses. So if you're on the fence about how you're going to do your R&D, whether you want domestic or offshore, there's now a more powerful incentive to do that domestically because you can write off that expense currently as opposed to having to spread that cost over 5 years. And then there's another provision that will enable you to go back a few years. Adam, you want to speak to that for the small businesses?
So if you have less than 31 million in gross receipts, you're considered a small taxpayer under 174 and small business taxpayer, and you're able to go back if you choose to and retroactively deduct any capitalized domestic R&D expenses in 22, 23, and 24. And the IRS has recently put out some guidance on how to do that. That guidance was not as favorable as we were hoping it would be. So if you're a partnership, you have to go back and actually amend 22, 23, and if you've already filed your 24, amend 24.
Right.
But there is that provision available for C corporations. They're able to go back. It's a little easier, just amend the return in 22, 23, and 24 to capture that. And then the good news is that you have some flexibility. All taxpayers have flexibility in 25, so for their 25 tax year, to be able to retroactively deduct any unamortized domestic expenses that are carrying forward. So they're basically going to let you catch up those expenses in 25 and take those deductions. And you have some flexibility there in 25 when you do that.
Yeah, and I've seen a lot of transactions in a private equity context where there are some large unamortized 174 expenses hanging out there, 10, 8, 20, $30 million. And to be able to write that off right before you do your deal in the year of change, I think is going to be a very favorable tax benefit for a lot of these taxpayers.
Absolutely. And that's another provision that portfolio companies are already seeing some benefit in tax distribution calculations and just sending out estimates to their partners, being able to factor in that carry forward deduction, if you will, in 25.
Yeah, that's right. So very nice tax incentive there, a nice change, taxpayer favorable change under 174 with the R&D expenses. Another area we're seeing have a very positive impact for taxpayers is with respect to bonus depreciation. Adam, you want to speak to that a little bit?
Yeah. So bonus depreciation, it was scheduled to be at 40% in 2025, and the new law, the One Big Beautiful Bill, raises that back to 100% and makes it permanent. So we now have 100% expensing available in 2025. Now there is a caveat that for any property that there was a contract in place prior to January 19th of 25, that property will not be eligible for 100% expensing. But really like this provision, it provides taxpayers certainty and gives them the ability to plan for those future capital expenditures. And with it being permanent, again, a lot of certainty there, and that's effective for 25.
Yes, and in addition to that, you can actually deduct currently qualifying buildings right into manufacturing arena as well. So if you're private equity context, if you have a portfolio company that's in that space, can you tell us a little bit about that deduction as well?
Yeah, so qualified production property, QPP, is new with the One Big Beautiful Bill, and that allows you to write off 100% of manufacturing property. Now, any portion of the building that's related to sales or admin, that's not going to be eligible for 100% expensing. We still do have the January 19th date, so if you had a contract in place prior to January 19th, our read right now is that would not be eligible for 100% expensing. There is a caveat out there that you have to continue to use the property for 10 years, so that's something, or you trigger ordinary income recapture if you dispose of the property within 10 years. So we'll have to keep an eye on that. But very favorable change for manufacturers to be able to write off what historically had to be
39
recovered
years,
over
right.
39 years, now can be a large portion of it written off in the first year. So very favorable change there.
I've got a private equity-backed portfolio company that's planning on taking advantage of that this fall, so they're excited about that benefit.
So Dave, we've talked about just a few of the changes that affect private equity and their portfolio companies. What should private equity companies be doing today in light of these new provisions? I think one thing that we've seen a lot of already is taking advantage of these provisions, if you will, in the tax distribution calculations.
Right.
So that's probably the immediate thing to do, is to factor these into your estimates that you're sending your partners and tax distribution calculations. And then as we learn more about these provisions, just being in a position to take advantage of them. And QPP is a big one out there. We'll learn a lot more about that one here in the future as the IRS puts out more guidance. But I think just being aware of these provisions and being prepared to take advantage of them going forward.
Yeah, I think the year-end planning season this year is going to be really, really helpful and save folks a lot of money.